Have you ever, I don't know, notice how emerging markets just always seem to be teetering on the edge of some financial crisis?
Yeah, for sure.
We all know they can be a little risky, but it makes you wonder,
Right.
is it just me? Or does it feel like they get hit way harder and way more often than other economies? Like, what's the deal with that?
It's a really good question. And it's something that Michael Pettis, he actually tackles this head on in the volatility machine.
Okay.
He noticed this interesting thing, even countries that seem to have their act together, like good economic fundamentals on paper.
Right. Doing all the right things.
Exactly. They were still getting slammed by crises left and right,
Yeah.
almost like they were being set up to fail, even when they were playing by the rules.
Yeah. It almost feels rigged, doesn't it?
It really does.
So what's the catch? If it's not just about having good policies in place, what are we missing here?
Well, that's where Pettis' argument gets really interesting. He says it's not just about the policies themselves, but more about how those policies actually affect the way a country structures its borrowing.
Okay.
He uses this analogy of building a house in a hurricane zone.
Mm.
You have the best building codes, the strongest materials,
Right.
but if the foundation is weak, even a minor storm can cause some serious damage.
That's a great analogy. So how does this whole financial house idea actually apply when we're talking about entire countries and their economies?
So picture this. Capital flowing in and out of countries, almost like the tide, right?
Okay.
Sometimes it rushes in, eager to invest in all these new opportunities, and then suddenly it rushes out, seeking, safer havens somewhere else
Yeah.
in emerging markets because they're still, kind of finding their footing in the global economy.
You're still growing.
Exactly. They're like small boats on this vast ocean of capital.
I like that.
They get tossed around by these huge tidal waves much more easily than larger, more established economies.
That makes a lot of sense. I mean, we've all seen what a rogue wave can do to a small boat. It's
Right.
not pretty.
Exactly.
So what is it that actually drives these massive shifts in capital flow? Where do these waves come from in the first place?
Pettis calls this the liquidity cycle. And get this, it's often driven by forces completely outside the emerging markets themselves.
Oh, wow.
Think about things like changes in interest rates set by, say, the U.S. Federal Reserve,
Okay.
or the introduction of some new, shiny financial instrument that has investors going crazy. These changes can create these huge surges or withdrawals of capital.
Wow.
And oftentimes, it's the emerging markets that are left to deal with the fallout, whether they like it or not.
So let me get this straight. Even if a country is doing everything right internally, some random change in, I don't know, U.S. interest rates could totally leave them high and dry.
Yeah, that's exactly right.
That just doesn't seem fair, does it?
No, and that's a really important point that Pettis makes in the book. You see, a lot of these emerging markets are facing these challenges that really have very little to do with their own actions or policies.
Right.
But it actually gets even more complicated than that. He argues that the very way that many of these countries borrow money actually makes them even more vulnerable to these external shocks that are totally outside of their control.
Oh.
He calls this the capital structure trap.
Okay.
And let me tell you, it's a real doozy.
Capital structure trap. That sounds kind of ominous, to be honest. What exactly does that mean?
All right, so think about it like this. Imagine taking out a mortgage to buy a house, right?
Okay, yeah.
Standard stuff. But here's the catch. With this particular type of mortgage, if the value of your house goes down, your monthly mortgage payments, they actually go up.
What? It's terrible.
Yeah, not great, right? Unfortunately, this is essentially the situation that a lot of these emerging markets are dealing with.
Ouch. That sounds like a recipe for financial disaster waiting to happen.
It really is.
How do they even end up in that position in the first place?
Well, it often starts with, the allure of cheap credit. Who doesn't love a good deal, right?
Okay.
But a lot of these emerging markets, they get stuck borrowing in foreign currencies, like especially U.S. dollars,
Sure.
because the interest rates might be lower.
Okay.
Seems like a no-brainer, right?
Yeah.
But this strategy, it comes with a hidden risk.
Let me guess, as soon as their local currency weakens, which, let's be honest, tends to happen when a crisis hits.
Exactly.
Their debt burden just explodes because those dollar payments are suddenly way more expensive.
You got it. You're exactly right. It's like their mortgage suddenly doubled overnight, but their paycheck stayed exactly the same.
Ouch.
Pettis actually uses Argentina's currency board back in the 1990s as a perfect example of this.
Okay.
So they decided to peg their currency, the Argentine peso, to the U.S. dollar,
Right.
hoping that by doing so, it would, create stability in their economy.
Makes sense on the surface, right?
Exactly. Stable currency equals a stable economy. Seems pretty logical.
Mm.
But here's the thing. When a crisis inevitably hit,
Mm.
they were completely powerless to adjust their currency to kind of like ease the pressure a little bit.
Right, because they were pegged to the dollar.
Exactly.
Yeah.
Their hands were tied because of that peg. And because they had taken on all this debt that was denominated in U.S. dollars,
Right.
that debt, it just became this massive burden, just dragging them deeper and deeper into crisis.
Wow.
So the very system that they put in place to try to create stability,
Right.
it ended up making them even more vulnerable.
Wow.
Just a classic example of the capital structure trap in action.
So if that's the trap, what's the solution? If borrowing in these foreign currencies can backfire so spectacularly,
Yeah.
how can these countries protect themselves?
Well, Pettis, he's got some pretty fascinating ideas about this. He suggests that maybe we should take a page from a bit of an unexpected source. Corporate finance.
Corporate finance. Now, that's not at all what I was expecting.
I know, right?
I thought we were talking like global economics, high-level stuff.
Right, yeah.
Not like, how businesses balance their books.
I know, it seems a little strange.
Yeah.
But there are actually a lot of really interesting parallels.
Okay.
And you'd be surprised how much these seemingly different worlds can actually learn from each other.
Interesting.
Because companies, over time, they've actually become quite sophisticated in the way that they manage risk. And Pettis believes that countries can take some of those same principles and apply them to their own borrowing strategies on a much larger scale.
Okay.
He calls this concept correlated funding.
Correlated funding. I like it already.
And it's basically this idea of aligning how you borrow with how you earn.
I see. Okay. So break that down for me. How do you actually correlate funding in that way? What does that look like?
Okay, so let's say you have a country whose main export is oil, right?
Okay.
So instead of borrowing in U.S. dollars where the payments are fixed, no matter what.
So whether oil's up or down, those payments are the same?
Exactly, regardless of how much oil they're actually selling. What if they issued bonds where the payments actually go up when oil prices are high, and then conversely, they go down when oil prices are low?
Oh, that's interesting. So it's almost like building in a financial shock absorber. When times are good, they're raking it in from oil exports. They can easily handle those higher debt payments. But then if oil prices plummet, their debt burden eases up a bit at the same time, giving them a little breathing room to,
Exactly. It's all about creating a more kind of natural hedge against those external shocks.
Right.
So instead of amplifying all the ups and downs of the global economy,
Yeah.
this approach actually helps to smooth them out a little bit and hopefully create more stability and resilience in the long run.
That's a really elegant solution. It just seems like common sense when you put it like that, but I imagine it's probably not always so easy to implement in practice, right? But what about when a crisis does hit? Is there any way to kind of I don't know, fix the damage once the financial house has already started to crumble?
This whole conversation has really got me thinking about this idea of debt forgiveness.
Yeah.
We hear about that a lot, especially for countries that are really struggling.
Right.
But it always seems like kind of a touchy subject,
Yeah,
Is that something that Pettis, does he address that at all in his book?
he does. Yeah.
Okay.
That's actually one of the things I find most interesting about the volatility machine. He really challenges, the conventional wisdom around this whole idea of debt forgiveness.
Okay.
Because oftentimes, you hear the argument that, well, if you bail these countries out, it creates a moral hazard.
Right.
Like they're just going to go and do it again.
Right. They have no incentive to get their act together, their finances in order.
Exactly. But Pettis, he makes this really compelling argument that in some cases, holding on to all this unpayable debt,
Yeah.
it can actually cause more harm than good. Almost like throwing good money after bad.
Yeah, kind of.
Yeah.
You imagine a country that's just drowning in debt,
Right.
and then they need, jokes. They need even more money, right?
Right.
And so Pettis' point is that this massive debt overhang, what it ends up doing is it actually scares away new investment.
Because who wants to invest in that?
Exactly. It's like, imagine you're a company and you're thinking about, maybe opening a new factory in a developing country, right?
Oh, okay.
Seems like a good opportunity. But then you take a look at their books and you realize, oh, wow, they're totally drowning in debt.
Right.
And it's pretty clear that a huge chunk of any future profits would just go straight to paying off these old debts.
It's not a great investment.
Exactly. It's like, are you really going to put your money into that? Probably not.
Right. You'll probably go somewhere else.
Exactly. And so that's kind of, that's where Pettis is coming from with this. He's saying that sometimes, strategically forgiving some of that debt
Yeah.
can be the thing that unlocks a ton of future growth and attracts all kinds of new investment.
So it's almost like, clearing out the dead wood to make way for new growth.
Exactly. That's a great way to put it. Like, you wouldn't try to plant a garden in soil that's already totally choked with weeds, right?
Right.
You got to make space for the new stuff to grow.
So it's not about just like letting anyone off the hook completely. It's more about creating a path forward.
Yeah, it's about sustainability,
Right.
right? It has to make sense for everybody.
That makes a lot of sense. So are there specific things that Pettis recommends, like in terms of how to actually approach debt relief in a way that's, I don't know, responsible and effective?
Yeah. So one of the things that he talks about are these really innovative approaches to debt relief,
Yeah.
where you're actually incentivizing countries to make real changes, to kind of reform their economies.
So not just a handout, but like you have to meet us halfway.
Exactly. And one of the ideas that he proposes is, you could actually link debt forgiveness to specific outcomes.
Okay, so like what? Give me an example.
Okay, so let's say a portion of a country's debt is forgiven, but only if they can achieve certain targets. Like maybe they need to implement certain economic reforms, maybe they need to improve transparency, reduce corruption, things like that.
So it becomes less about like charity and more about like a partnership.
Exactly. You hit the nail on the head. It's about creating this kind of shared commitment to building a healthier and more stable economic future for everybody.
It's a win-win, right? I
Yeah.
mean, the country gets some relief from this crushing debt, but they also have this incentive to make changes to hopefully, chuckles, not end up back in that position again.
Yeah, exactly. And I think that's what's so compelling about Pettis' work, right? Is like he's really asking us to sort of rethink these assumptions that we have, these long-held beliefs.
Yeah, it's really changed my perspective just in this short amount of time we've been talking.
Yeah.
What would you say, like, what's the biggest takeaway for you from his work?
I think the biggest takeaway is that these situations are really complicated,
Yeah.
and we need to move beyond just these simplistic solutions.
Right. There's no easy answer.
Exactly. It's so easy to fall into that trap of, well, they just need to adopt free market policies and, tighten their belts and everything will be fine.
Right.
But it's way more nuanced than that.
Right. And there are all these other factors that are influencing these situations.
Exactly. We can't ignore the role that global capital flows play in this and how these flawed borrowing structures,
Right.
how they contribute to these cycles of volatility and crisis.
Yeah, absolutely. It's not just about what's happening within a country's borders. It's about the whole system.
Exactly. That's
Yeah.
a really good way to put it. It's about this whole global system.
Yeah.
And it's really about understanding, too, I think, that, like you were saying, one size doesn't fit all.
Yeah. You can't just apply the same solution to every single country and expect it to work.
Exactly.
Well, this has been a fantastic conversation. I feel like my brain is like full of new ideas.
A lot to digest, yeah.
It is, but it's
Yeah.
all really important stuff, and it's really changed my perspective on a lot of these issues. Hopefully our listeners feel the same way, that they come away from this conversation, this deep dive, with a new understanding
Yeah.
of, all these complex issues. So it's been a real pleasure unpacking these ideas with you.
Likewise. Always great to chat with you.